Exploiting intermarket correlations is a great way to improve your trading edge. Here I'll explain the 3 types of correlations that every Forex trader should know, and demonstrate how you can make better trading decisions with knowledge of these correlations.
Interest rate differentials have been the most consistent driver behind currency valuation. There are 2 main reasons for this. Investors favor currencies that pay higher interest, and many factors that cause rises in interest rates, such as higher GDP and inflation numbers, also support the currency. Currency valuation and interest rates therefore move in tandem. An increase in rates is usually a good predictor of an upcoming increase in currency valuation. Central bank speeches and interest rate decisions are among the most keenly anticipated events on the Forex calendar. If the central bank signals an intention to increase rates, the currency often rallies significantly, and vice versa. The chart here shows how the Aussie dollar tumbled when the central bank unexpectedly cut rates from 2% to 1.75% in May 2016. Since Forex traders deal with currency pairs, what matters is not the currency's interest rate per se, but the interest rate differential between the 2 currencies of interest. This interest rate differential is usually correlated with the currency pair's movement. This multi-year chart shows how the Aussie dollar closely tracks the differential between the 2-year Australia government bonds and the 2-year US government bonds. As the Australian bond yields decrease relative to the US bonds, the Aussie depreciates relative to the dollar. While this correlation between currency performance and interest rate differentials generally holds true, there may be differences in the magnitude of the move, and one market may slightly lead or lag the other. Let's look at the US dollar pairs first. The dollar tends to have an inverse relationship with commodity prices. There are 2 reasons for this. Firstly, commodities are usually priced in US dollars. Check out how crude oil price falls when the US dollar index rallies. A stronger dollar makes commodities more expensive for consumers, reducing demand and pushing commodity prices lower. Secondly, when most commodity exporters sell their products, they are paid in US dollars. To balance their assets, exporters often sell the dollar and diversify into other currencies. The greater the demand for commodities, the more the dollar is sold off. Next up are the commodity currencies. These are currencies from countries that depend heavily on commodity exports. There are 3 main commodity currencies: the Canadian dollar, the Aussie, and the Kiwi dollar. These countries are huge exporters of the following products. Stronger demand for these commodities is bullish for the currency. Let's take the Canadian dollar for example. When oil exports increase, Canadian businesses receive more US dollars, and subsequently convert this to Canadian dollars to sustain their local operations. Canadian GDP and employment numbers etc. improve, which may in turn raise interest rates. These create demand for the Canadian dollar. Here's the inverse relationship between the dollar Canadian and WTI oil. The 2014 oil price crash, triggered by booming US shale production, led to a sustained dollar Canadian rally. Being the most heavily traded currency, USD pairs tend to move in tandem. Take the euro dollar for example. Making up almost 30% of Forex turnover, most traders use it to express their view on the US dollar. The euro dollar, pound dollar, Aussie dollar and Kiwi dollar have moved in tandem for most of 2020 and 2021. If the euro dollar is bullish, and barring major changes in non-US dollar currencies, chances are the downward momentum of the dollar will carry over to the other majors. Likewise, if markets are quiet and the dollar Canadian suddenly moves higher, there's a good chance that the Aussie dollar will have short-term weakness. Armed with your knowledge of Forex correlations, here's one way you can fine-tune your trade selections. First, shortlist currency pairs that have diverged from the markets they are traditionally correlated to. For these currency pairs, you may implement a long or short-only trade filter, or amend your position sizes. Finally, enter the market using your existing strategy rules. I'll demonstrate this using the persistent correlation between the Canadian dollar and oil price. Suppose it's June 2021 and I'm trading the 1-hour dollar CAD, looking to exploit a divergence between the Canadian dollar and WTI crude. The crude prices have been inverted for clarity. Normally, with a rally in crude, you would expect CAD strength and resulting weakness in the dollar CAD. Here the consistent uptrend in the dollar CAD indicates a clear divergence. To figure out what's driving this divergence, I turn my attention to the US dollar index, or DXY. This index measures the dollar's strength against a basket of 6 foreign currencies. Here's the dollar index at the time of the divergence. the US dollar looks overbought, having had 3 consecutive penetrations of the upper Bollinger Band on the daily time frame. It turns out this strong rally was triggered by the Federal Reserve bringing forward its projections for the next rate hike to 2023. I am therefore bearish on the dollar CAD for the following reasons. Crude oil is bullish. The dollar looks overbought, I expect a correction soon. And lastly, the 1-hour dollar Canadian is at a daily resistance level and the shooting star shows strong rejection of price. As long as this divergence persists, I will avoid going long on the dollar CAD. I'll go short if my existing strategy entry conditions are met. Going short at this instance, perhaps by using a Bollinger Bands or Donchian Channels reversal strategy, would have yielded about 150 pips. So the next time you're looking to shortlist high probability trades, do consider the 3 intermarket correlations mentioned in this video. Confluence between fundamental and technical setups will swing the odds in your favor. I don't recommend solely using correlations as the basis for entering a trade, although there are many short-term algorithms that specifically exploit tiny divergences. Even if you do not use correlations to inform your trade decisions, understanding the economic drivers behind the markets will make you a well-rounded trader. Don't forget to like and subscribe. If you're interested in an automated Bollinger Bands reversal strategy, check out the video at the top right. To learn how to program your own trading strategy, check out the video at the bottom.